Beginner's Guide to Investing. How to make the most of your first $1,000. Investing your first $1,000 can be an exciting and rewarding experience, but it can also be overwhelming if you're new to the world of investing. Here are some steps to help you get started. Establish your financial goals. Before investing, you should consider your short-term and long-term financial goals. Ask yourself what you hope to achieve by investing and how much risk you are willing to take. Establishing your financial goals is an important first step in investing. Here are some questions to consider when setting your financial goals. What do you hope to achieve by investing? Are you looking to build long-term wealth, save for a specific goal, such as a down payment on a home or college tuition, or generate income? How much money are you comfortable investing? Do you have an emergency fund in place to cover unexpected expenses? What is your time horizon for investing? Are you looking to invest for the short term, less than 5 years, or the long term, 5 years or more? What is your risk tolerance? Are you comfortable with the ups and downs of the stock market, or do you prefer a more conservative approach? Do you have any other financial obligations or debts to consider? Are you saving for retirement or paying off student loans? By considering these questions, you can establish clear financial goals that will guide your investment decisions. It's important to revisit and adjust your goals over time as your financial situation changes. Determine your risk tolerance. Your risk tolerance is a measure of how comfortable you are with the potential ups and downs of the stock market. Generally, the more risk you are willing to take, the higher your potential returns. Determining your risk tolerance is an important step in investing as it helps you identify the level of investment risk that you are comfortable taking. Here are some factors to consider when assessing your risk tolerance. Investment goals. Your investment goals will determine the level of risk you can afford to take. For example, if you're investing for a short-term goal, you may want to take less risk than if you're investing for a long-term goal. Time horizon. The length of time you have to invest can also impact your risk tolerance. If you have a long-term investment horizon, you may be more comfortable taking on higher risk investments. Investment experience. Your experience with investing can also impact your risk tolerance. If you're new to investing, you may be more risk-averse until you gain more knowledge and experience. Financial situation. Your financial situation can also impact your risk tolerance. If you have a stable income, emergency savings, and low debt, you may be more comfortable taking on higher risk investments. Personality. Your personality and temperament can also play a role in your risk tolerance. Some people are naturally risk-averse, while others are more willing to take risks. Once you've considered these factors, you can use various tools and resources to help assess your risk tolerance, such as online questionnaires or consulting with a financial advisor. It's important to choose investments that align with your risk tolerance to help you achieve your financial goals while minimizing the risk of losses. Research investment options. There are many different types of investments, including stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Each has its own unique risk and return profile, so it's important to do your research and understand what you're investing in. How to make the most of your first $1,000. If you have questions, feel free to comment down below. Researching investment options is an important step in investing as it helps you make informed decisions about where to put your money. Here are some common investment options to consider. Stocks. Stocks represent ownership in a company and offer the potential for long-term capital appreciation. They can be purchased individually or through mutual funds or exchange-traded funds, ETFs. Bonds. Bonds represent debt issued by corporations or governments and offer a fixed rate of return. They can be purchased individually or through mutual funds or ETFs. Mutual funds. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Exchange-traded funds, ETFs. ETFs are similar to mutual funds in that they offer exposure to a diversified portfolio of assets. However, they trade like individual stocks on an exchange. Real estate. Real estate investments can include rental properties, real estate investment trusts, REITs, or real estate crowdfunding platforms. Alternative investments. Alternative investments can include commodities, hedge funds, or private equity. When researching investment options, consider factors such as historical performance, fees, and risk level. It's also important to ensure that the investment aligns with your financial goals and risk tolerance. Consulting with a financial advisor can be helpful in identifying suitable investments and creating a diversified portfolio. Open a brokerage account. To invest in the stock market, you'll need to open a brokerage account. There are many online brokers to choose from, so compare fees, investment options, and user reviews before making a decision. Opening a brokerage account is a necessary step for investing in stocks, bonds, mutual funds, ETFs, and other securities. Here's how you can open a brokerage account. Choose a brokerage firm. There are many online brokerage firms to choose from, including well-known names such as Charles Schwab, Fidelity, and Vanguard. Compare fees, investment options, customer service, and other features to choose a brokerage firm that suits your needs. Fill out an application. Once you've selected a brokerage firm, you'll need to fill out an application to open a brokerage account. The application will ask for personal information such as your name, address, and social security number. Fund your account. After your application is approved, you'll need to fund your account with cash or securities. Many brokerage firms offer a variety of funding options, including bank transfers, wire transfers, and checks. Choose investments. Once your account is funded, you can begin to invest in stocks, bonds, mutual funds, ETFs, and other securities. Many brokerage firms offer tools and resources to help you choose investments that align with your goals and risk tolerance. Monitor your investments. It's important to monitor your investments regularly to ensure that they continue to align with your financial goals and risk tolerance. Many brokerage firms offer tools and resources to help you track your investments and make informed investment decisions. Opening a brokerage account is a straightforward process, but it's important to choose a reputable brokerage firm and to understand the risks associated with investing. Consulting with a financial advisor can be helpful in selecting suitable investments and creating a diversified portfolio. Start with a low-cost index fund or ETF. For beginner investors, a low-cost index fund or ETF can be a good option. These funds track a specific index, such as the S&P 500, and offer broad exposure to the stock market. They are also typically less risky than individual stocks. Starting with a low-cost index fund or ETF, exchange-traded fund, is a popular and effective way to invest for beginners. Here's why. Diversification. Index funds and ETFs provide instant diversification by investing in a large number of stocks or bonds. This helps to spread risk and can help to minimize losses. Low costs. Index funds and ETFs typically have lower fees than actively managed mutual funds because they simply track an index and require less management. Performance. Research has shown that index funds and ETFs often outperform actively managed mutual funds over the long term. Simplicity. Index funds and ETFs are easy to understand and require minimal effort to manage. This can be especially appealing to beginner investors who may not have the time or expertise to manage individual stocks or bonds. When choosing a low-cost index fund or ETF, consider factors such as fees, historical performance, and the underlying index or assets. Some popular index funds and ETFs include the Vanguard Total Stock Market Index Fund, VTSMX, the iShares Core S&P 500 ETF, IVV, and the Schwab US Broad Market ETF, SCHB. Keep in mind that investing always involves some level of risk, and it's important to have a diversified portfolio that aligns with your financial goals and risk tolerance. Consulting with a financial advisor can be helpful in selecting suitable investments and creating a long-term investment strategy. To learn more about life, business, and technology, subscribe to this channel. See you on our next video.